Hey everyone, Dr. Johnny from the Walk of Wealth here. If you're a high income professional, especially a dentist, as many of the people that watch this channel are, you already know the pain, right? We work really hard, take great care of our patients, take care of our staff. We earn a great income, but then a huge chunk of it disappears to taxes. So the real question becomes, okay, well, it seems like we're running on a hamster wheel after a while because it's like the harder you work, the more you make, the more taxes you pay. So the real question becomes, how do you keep more of what you make while still building long-term wealth? Right? So this is about thinking a little bit differently. It's not running on a hamster wheel. It's, hey, let's take a step off of the hamster wheel and let's think about what we can do to mitigate this rather than just keep trying to earn more. Now, today we're going to talk exactly about that. And I've got a great guest joining us, someone who is not just talking about this stuff, but he's actually doing it in the real world. I see him doing it on my social media feed. And it brings me great joy and pleasure to see another fellow colleague that's really excelling in this world of real estate that we've all sort of fell in love with, even aside from our dental careers. Now, this handsome man here is Dr. Josh Cochran. He is a practicing dentist and the founder of Cochran Capital, which is a real estate firm focused on helping high-income professionals grow and protect their wealth through strategic real estate investing. He specializes in tax advantage strategies, things like opportunity zone investments, equipment financing, and real estate syndications, all designed to help professionals reduce their tax burden and build passive income at the same time. And what I really respect about Josh is that he's passionate about financial education within the dental community, very similar to me, helping people make smarter decisions instead of just working harder year after year. Now, in this conversation, we're going to break down how tax advantage real estate strategies actually work. But very specifically, we're going to be talking about it's an equipment. I don't even want to butcher what it is, but this is a novel strategy, at least to me. I think Josh, when he learned about it, was novel, and we, as dentists that try to shed light on these other avenues and pathways that aren't presented to us by our traditional financial advisors. And Josh, I want to warmly welcome you to the show. It's great to have you here.
Johnny, great to catch up. It's good to hear about your family and what you guys have been up to. And yeah, it's good to catch up in person. Very glad to be here today.
Thank you, man. I appreciate it. So let's jump right into what are we going to talk about today. Now, you came and presented this to our group of fund managers, and it's a very novel strategy. So let's jump into this novel strategy that's very effective at, especially for this. Now, this strategy isn't for everyone. I'm going to tell you guys that right now, right at the front, so we can set expectation. This is for income earners. And it's not because we're discriminating against anyone that is an extreme high income earner. It's because this strategy is specifically tailored for a specific profile of person. So Josh, let's jump right in. Let's talk about the strategy that you've uncovered.
Yeah, I think starting with the pain, I mean, most motivation comes from pain. So I think you highlighted it well. When I started my first practice, I was an associate for a couple of years, not really making much. Started my own practice, made $0 the first year, right? Uh, and you keep doing the good habits, right? You keep coming to work, you keep grinding, and just doing the good habits, your business grows, you start earning an income. And once you start earning an income, you start learning about things like paying quarterly taxes. You're like, I didn't even know this is a thing, right? And
I got shocked too. Yes.
yeah, yeah, like the IRS wasn't there when I was like, grinding away, but as soon as income comes, they're right there. So
Give me my cut. Yes.
and I've never wanted to just keep putting one foot in front of the other. Like I always questioned why the whole time, right? And so I'm like, why am I like working my butt off and then just writing these huge checks? And it's like I love like roads, schools, police, fire. but I don't feel like the government is the most efficient allocator of funds, right? It's been proven many times they're very inefficient. So it just really rubbed me the wrong way. Um,
Especially when they're printing money faster than that you can, none of us should even have to pay taxes because they print
no,
enough money to cover these burdens,
no.
right? So,
And you start reading, like you start going deep on this stuff if you want, and sometimes it's like we're technically not even required to pay income taxes, right? Like you start
yes.
reading the laws and stuff, like all this. Anyway, so I was just like, okay, like this is what I'm doing. I'm doing dentistry, and it's like, well, what else can I do, right? And real estate popped on my radar, and I absolutely loved it. It was something I always loved, and so I just started doing a ton of real estate, and then I cut back at the dental office and cut back enough, right? Maybe a day a week clinically or something. And so most of my time was on real estate. So I started, became the real estate professional like many and use that depreciation to reduce my taxes. It's fantastic. And I love real estate. I mean, it creates a lot of freedom for my family, right? My health is way better. My time freedom, my geographic freedom. I can do my real estate developments from anywhere in the world. It's just been really great for me and my family. That's one option, and that's an option that a lot of people know about. But I'm a relentlessly curious person. I was honors finance, business degree honors finance in undergrad, and so my brain always just kind of leans this way. So I'm always keeping my ear out for like different stuff, vetting them, etc. And the one we're going to talk about today is equipment and bonus depreciation. So let me tell the story. Actually, Simon, our good buddy, this is one I think I heard first from Simon. We were just shooting the breeze one day, complaining about
Simon
something.
Balin, the great Dr. Simon Balin, another great colleague
Yeah,
of mine.
yeah.
Yes,
Maybe
yeah,
this
keep
was
going. Yeah,
4 years
he's
ago.
been
We
a guest
were,
on the show. Yeah, good friend of mine as well. Yeah, keep going. I love his story as well.
yeah, smart guy, hardworking guy. And we were just kind of chatting about stuff, and we're both in construction and stuff. And he's like, I think I was talking about something, and he's like, dude, why don't you just like buy like the heavy equipment and have your contractor use it, and he'll just pay you for it. And I go, what? And he goes, yeah, man, like just like you buy like a CT machine at your dental office, right? When the bonus depreciation is at 100%, like it is today, right?
Mm.
You can buy that thing leveraged, right? Don't put a lot of money down, right? I don't know, 10, 20% down on the equipment. And me,
Mm.
you get to write off all 100% of the value of that equipment like that year. I was like, what? Like, why did I never think about this, right? Like,
Mm.
so I started looking into it, and yeah, it's totally viable, right? Like, one, like, why would the federal government do this, right? First of all, right? They're
Yeah.
in the business of like collecting taxes. So what they're incentivizing you is to go out and buy equipment, whether it's for your dental office, whether it's for construction, whether it's huge giant machinery used in manufacturing, right? You put money out for equipment, it means you're going to create value for the society. You're growing something. It means there's going to be more taxes in the future. You're basically growing the economy, right? So just like they incentivize us in real estate to build buildings for commerce or for housing, they incentivize us to invest in equipment to create more widgets. Um, so when I started to understand this, I'm like, oh, this isn't like some scam. This is like real. Like the feds do this on purpose, right? And you even saw like in the big beautiful bill last year that came out, like the Trump administration, they want manufacturing to grow in the US, right? So they brought back 100% bonus depreciation. They're like, go forth, start producing in the US, right? Let's go, right? So I started learning about this after Simon mentioned it, and first thing I did was kind of the same thing. I bought some equipment for one of my contractors, right, and they were using it, and so I got all the depreciation, and they were kind of basically just paying the debt for me, right? And I was like, wow, like I think I don't know, my first equipment was maybe let's say 400 grand, right? So I got to write off like all 400 grand off my income that year, right? For me, that's like 150K in taxes I didn't have to pay,
Yep.
right?
Yep.
And so I was like, oh, this is pretty sweet. And then kind of over the years, I kept on doing that with different people I'd meet. But you know how it is when it's like not your business, like how high integrity does this person have? Uh, how well is their business being run? Are they going to be able to pay me for like renting this out? Because like,
Right.
renting your equipment out, it's a whole nother business, right? And I got a lot of other things going on. I don't have a lot of time to really focus on that, right? I was doing demo
Hmm.
before. Now I'm real estate developer, real estate contractor. We also have an excavation business, and then I'm a fund manager, right? Similar to you. I got my 3C1 fund, I got my opportunity zone fund, I do SPVs, joint ventures. It's just like I don't have time for another business, right? Because you just dilute yourself and you just do a poor job at something, right? The outcomes aren't great. So,
Yep.
so every year I've been doing this because it's so good. And the way I kind of look at it, you just like take your million. Let's say this is for higher income earners typically, right? So like 500K or plus, a million, 2 million. These are the people I see use it the most. Family offices use it a lot, 20, 50 million. But I'll just use like 1 million as like simple math for folks, right? So if I got like a million in income, just like my first million, let's say it might be taxed at like 325,000. I'm writing a check to the IRS this year, right? Just right?
Yep.
And
Yep.
everybody who pays quarterly just hates it, right? They're just like,
Hmm.
dude, I
Hmm.
just wrote like a $75,000 check to the IRS today. This blows, right? My
Fucking
bank account
sucks.
was looking
Yeah.
good.
Yeah. Yeah.
Uh,
Feel dirty,
uh,
man.
you feel it, right? You feel
Yeah.
it.
Yeah.
And so I was like, okay, well, if I start doing real estate, right, as you know, we do the real estate, we do get the depreciation, we do a cost segregation to accelerate that depreciation so we get more up in year one, and that's great. But you have to be buying real estate that year, and if you're building real estate, you don't get to take that depreciation until the building's finished, right?
Mm.
And so, like, it's just timing of things. Sometimes I have enough real estate depreciation and I'm good, and sometimes I don't. Okay. So if I got like a million in income where I don't have enough real estate depreciation, if it's the first million, I'm probably paying 325 in taxes. For the second million, I'm probably paying like 350 grand in taxes. It's a real problem, right? And every dollar that you and me have, right? Like my average annual return on my real estate exits is 49% annual average return and a 37% IRR, right? So I know, like historically, if I can keep a dollar and not write a check and send it to the IRS, right? If I can keep an extra 100 grand, 200 grand, well, I'm going to take that 100 grand and I'm turning it into 149,000 year one, right? And that 149 times 1.49 is another number, right? Like 260 or whatever the next year. Like I'm compounding my money via my real estate business. And so at a very rapid rate, like much higher than stock market on average or anything like that, right? So it's very important to me to be continue to grow this nest egg, so I can have freedom to do cool stuff with our kids, right?
Yep.
Skiing,
That's the
golf,
whole
play all those
purpose.
things we talked about. So like every year, yeah, like every year, I'm like, okay, I'm adding value to society by growing this real estate stuff, this housing, these commercial things for people to use that are growing the economy. And then I'm also doing that secondarily with equipment. So let's say my income was 2 million in a year, I had a million worth of real estate depreciation. I still got a million in income left that I got to take care of. I don't have any real estate finishing this year. I would go buy equipment. I would never invite my friends along though, because I'm doing these one-offs, right, with these small business owners. There's risk in that. I'm vetting them, I'm doing these things, but I'm really managing those relationships. There's risk. And so is this something I couldn't bring my buddies along on? I could tell them about it, but I couldn't be like, oh yeah, yeah, buy equipment with Johnny too. I just didn't know that it was going to be low risk enough for these folks, right? Because they're not equipment folks. They don't know. Um, and maybe 2.5 years ago, I started hearing about a very large company that was using this strategy to help them grow. So they're a large equipment rental company. They started in like 2015. They went to Peter Thiel's incubator in Silicon
Mm.
Valley.
Wow.
And they went there and they're like, hey, we have this, like, we're contractors. We hate when we rent equipment because, like, either we go to rent it, the guy says it's going to be there today, it's not there. or we get it, we take it to our site and it breaks because no one was maintaining it, right? And
Mm-hmm.
now like, it costs you a ton of money because like all the people who are supposed to be there that day can't do their job. Now the guys that are supposed to come after can't do their job. It's just like very expensive to not have a good equipment rental partner when you're a contractor. Very expensive. We're the same way on our business. So these guys were just like anything else, pain, right? Motivates. They're like, dude, this blows. How are we gonna do this better? And because they had that tech background, one of the things they first focused on, they really slowed down their plan and they focused on developing a software that they could put on all the equipment, like track where it is, how many hours is it being used,
Wow.
when has it been maintenance last? When does it need to be maintenance? Like all the data, right? They wanted like just-in-time data. That way, when they know where the equipment is, right? It's not lost, so they can always give it to their clients when they say they're going to, or they know, when something has been maintenance and when it hasn't. So they're not like delivering equipment that might have needed to be repaired or just oil change, like those types of things, right? They're on top of their game. And the big guys in the equipment rental world are United, Sun, and Herc. Those are like the three biggest. Okay, like I forget, United's like maybe 14 billion a year. La, la, la. So these guys are now. So they started 2015. Okay, imagine your dental. Dental. Like how things grow in dental. I started to practice from scratch. Like I said, I made no money my first year. Um, I worked my butt off. I don't know, after like 6 years, maybe the revenue of our business was like 15 million or something. Okay. These guys in like 10 years went to like 4 billion in revenue from
Wow.
zero, right? Like
In revenue, Jesus.
in revenue, right? I'm like, how do you even build that fast, right? Obviously, you got to find a problem that's a real problem, right? And then use technology to scale up. So they've been doing that. But as you know, as you scale a business, you see like these DSOs try to acquire practices. It's all about the debt. How cheap can they get the debt, right? And so when you're trying to grow a business much faster than DSOs grow, right? 0 to 4 billion in revenue in 10 years, you got to bring in a lot of capital to help you grow, especially in equipment, which is very capital intensive, right?
Mm-hmm.
So they would go out and get like institutional money, whatever at the interest rates of the day, let's say 5% or whatever, 6%, but it's still not enough. So they created a program called the OWN program, and they would go out and say to individuals like you and me, like, hey, buy the equipment, we'll rent it for you. Okay.
Wow.
It solves our tax problem, right? And we'll leverage our size to help you get better debt, right? And so they started in 2018, this program. So now you and me are like, oh, wait, like you're going to give me a return on my money. Like I don't got to do much, right? Like 100 hours a year, according to the IRS, and it helps you grow. I get a return, and I got like a massive tax benefit every year. So yeah, so they built that 2018. Continued to refine it over the years. I can't remember the number off the top of my head, but it's at least 4 billion, at least 3.8 billion of equipment's been through this program,
Wow.
right? Since 2018. So a lot of folks have been doing this. I mean, when I heard about it, I was like, I wish I knew about this 5 years ago, right? Like,
Seriously.
uh,
Yeah.
it's really good. So, and this company continued to grow. This year they went public, so now they're publicly traded. So when you think about risk mitigation, you're like, I always start with like, what's their track record? And these guys are just growing. They're doing great, right? And they're growing compared to their competitors because those differentiators with the technology, some of the other things they do. We use them locally with our construction company. We have equipment that we use every day, right? That's maybe like half the equipment, a third of the equipment. And then it's like the one-off stuff that we use, a week at a time, and then we don't use it again for 4 months. We rent all that stuff. And so we work with them. They're our favorite rental company to work with. They're great. So yeah, these guys went public this year. And what's great about when you go public is you have to reveal all your financials,
Yeah.
right? Like you get audited like more than
Left and
anyone
right.
can even
Yes.
imagine, right?
Yep.
So you have a growing company that's doing well. They're fourth largest, so they have like a long runway. They've got audited financials deep because they're a publicly traded company. So it just kind of reduced risk, right? You're not looking at like Ponzi scheme risk. You're not looking at, are they growing? You have all their numbers, they're public. The real risks are just like industry risk. And when I look at the equipment industry, I look at like historically what happens. Well, when a recession happens, one of the first ways the government look to like kick off the economy is they put money into construction, whether it's civil construction, roads, bridges, dams, or they put money into saying like, hey, let's build factories, right, on the private side. So usually construction and rentals bounce back quickly. And then two, when you look at like 2008, 2009, when we had like big recession there, equipment values dropped, but they only dropped to like 40% of purchase price on average, say after like 6 years. Okay. So there was a
Mhm.
little dip, but even in like a bad recession where like no construction was going on relatively, you still got just like a little dip. So, so anyways, that just seems like to me, it's like, okay, I'm in construction. I understand the business. I love betting on a winner that's doing well. I love publicly traded audited financials. And I love an industry that even in a recession, you know, doesn't get creamed and bounces back before other industries. So,
That's yeah, that's amazing. I mean, there's a lot to unpack there. Now, I guess let's unpack it first from an investor standpoint, right? Like now, okay, I earn 500K plus a year. I have a big tax bill. I have $150,000 that I can put towards a project like this to try to gain some of this depreciation. What is an investor exactly getting here?
yeah, let's go step by step on the numbers there. So if you're making, you want to say a million or 500K? What do you want to
So
do?
let's do a million because that's easier math, right? Like okay, so they're
Easier
making $1 million
math.
dollars, okay?
$1 million, your tax bill is going to be 325, right? And so you better have 325 in the bank. But
Exactly. Yeah.
let's say you only got 150. So
Okay, so you have 325 in the bank. Okay, so like we're making quarter. Let's say a guy just making $1 million. Now, if he's making quarterly payments, he's paying around 75K a quarter,
good
right?
point. It might be
Okay.
Q4, Q3. He's got 150. Yep. So this is why this is so much more powerful than the other strategies that we've looked at, right? Like oil and gas, these other ones that pop up it's just the math. This is
Okay.
about 8 times more tax efficient than oil and gas due to
Wow,
leverage.
and we're big oil and gas investors, and before that, we really love the tax man. Obviously, there's a great return profile as well, but let's zero in on that. So that's something people on this channel can sort of relate to, and it's like, all right, let's compare this to oil and gas investment. I think that's a great avenue to approach it. Yeah, so keep going down
Oil and
that path,
gas
Joe.
is oil and gas is cool, right? You're producing energy. People need energy. There's cool tax law around oil and gas. It's a nice part of your portfolio. And so, like another diversified depreciation strategy could be equipment for you, right? If you're already doing oil and gas. So, um, yeah. So how this would work? So you have $1 million in income. Your tax this year is going to be 325,000. Okay. Most people use leverage. You don't have to, but when you compare your options, almost everybody ends up using like max leverage on this when you
Okay.
start doing the math. So typically, for 100,000, you're putting in about for $1 million income to buy. You're going to want to buy $1 million worth of equipment because that $1 million of equipment can be all depreciated in year one due to the bonus depreciation rules from the big beautiful bill.
Okay.
Okay. How do you buy $1 million worth of equipment? You apply for a loan through the program. They
Mhm.
leverage their history, their size, all those things. You don't have to use a loan through them. If you have another lending option, we can talk about that, like a securities-backed line of credit against your stock account or something. Those are usually very inexpensive, like 5%.
Mhm.
Right now, I'm seeing around 7% on these loans on the equipment. So they help you go find a loan with all their partners they've already vetted across the country, their banking partners, and typically they're going to give you like 90 to 10 leverage. Okay.
Wow.
With everything and debt brokerage fees and stuff like that, it ends up you're putting in for that million worth of equipment, you're putting in
Yep.
130 grand in cash.
Okay.
Okay. So now I put in 130 grand in cash, I buy $1 million worth of equipment, and then they go out, they insure it for you, they rent it for you. They're actually pooling your equipment with like 25, $50 million worth of other people's equipment. That way, in case yours breaks down or I don't know, there was a blizzard in Maine for a month and nobody's going anywhere and not renting your equipment, your cash flows don't change, right? Because there's enough equipment, there's 50 million equipment in the pool, it all balances out, right? So you get very predictable returns. Um, so yeah, so they go out, buy the equipment from Equipment Share. That's the publicly traded company. This management company was basically spun out of Equipment Share. So as they continued to grow and started to do this program, they kind of spun this piece out of their corporate business. So this management group called Armada, they handle insurance, they handle repairs. They work with Equipment Share. Equipment Share doesn't want to work with you. They're a $4 billion company.
Yeah.
They don't want to talk to you. So they have this middle manager that handles it all. They buy the equipment from Equipment Share. They allocate it to you. They set up the lending. They just kind of do everything for you. Um, Now within, I mean, it's quick. I mean, they already have the equipment and it's already like going out in the field. So there's not like a delay of 6 months or anything. It's like typically the next month. You start getting checks for your rental checks, your share of the revenue shows up in your bank account. It's typically depends on the timing with interest rates and competitiveness, but it's about 16.25% is what I've been seeing lately.
Wow.
And
This
then
is
you, but
after paying their fees and their management fees and all of this thing, net.
there's debt, and then the debt comes.
And
So
the debt
your
service. Okay.
your net cash flow tends to be around 6 to 8% cash
Six
on
to
cash.
eight percent. Okay.
Yep,
And this
on
is
your
monthly. You're getting
130
monthly, quarterly.
monthly, and then you'll see the debt come out. Okay.
It's
So,
amortized.
yep, yep, amortized. So I think like a usually 10-year loan.
Okay.
So yeah, so you're getting a cash on cash return that's like similar to historical stock market, right? Historical stock market's like 7, 8%. You're getting like 6 to 8. So it's like in that range. You're like, oh, that's pretty good, right? But the big piece here is that massive tax benefit,
Right.
right? The year one. I was going to write a check to the IRS for $325,000, right?
Mm-hmm. Mm-hmm.
Instead,
You put
I'm
150,000 into buying
130
this
took the
equipment.
equipment, right? And then I'm keeping the other couple hundred K, right? And for
Mm.
you and me, we're rolling that into whatever our
Right.
investments are, right? Like
Correct.
real estate. We're trying to double
Yep.
that money every few years, right?
Yes.
Um, and then there are some tax requirements. The IRS says, hey, if this is real, this needs to be your equipment. So you got to own it and you got to be at risk on the loan.
Mm.
Okay? And then you need to actually be involved. And it's not like real estate, you got to be at 750 hours and it's got to be more than anything else you do, which is pretty hard, right? I mean, you really
Yep.
got to be all in on real estate to do that, or at
Yep.
least mostly in. So this one's 100 hours a year, is my understanding. And let me do my disclaimer. I was going to do it earlier, but I got carried away. I am not an accountant. I am not a financial planner. I'm not an attorney. These are just my
Yes. Yes.
personal experience, opinions and experiences. So
Yes. Yep.
so 100 hours is my understanding. And, I have my app. We already talked about the software, right? So I can see my equipment where it is every week, right? So I can put in about an hour a week. There's 52 hours right there. I can go visit the equipment share location locally. I can fly to the HQ in Missouri, which I do every year. There's 30 hours there. And it's actually a fun HQ. It's Missouri. It's like Mizzou, University of Missouri.
Yeah.
It's a fun college town. They have like
Mm.
7 $1 billion companies there. Excuse me,
Really? In Missouri?
seven
Well,
unicorns coming
shocking.
out of
That
this
I would have
little
never thought that.
little
Yeah.
farm, little farm town. Yeah,
Yeah.
college town. It's cool.
Unbelievable.
Um,
So So now to get that 100 hours, I mean, that part seems a little tricky. Okay, so now say I'm a busy, endodontist. I'm making 1 million plus a year. I don't necessarily have time to go and make that trip. I mean, maybe it's interesting and it's fun, but maybe I don't have that time. You have to do it only in the first year, or you have to do it every year, right? To
Yeah,
maintain that,
yeah,
right? So,
yeah. In the year you purchase the
oh,
equipment is my
okay,
understanding.
in the first year only. Okay, okay.
Yep. In the year you're purchasing equipment. So, yeah, it's 2 hours a week, between checking your app, emails. I mean, you can get there. 100 hours to me is not significant. I can
Insurmountable.
pretty quick. Yep.
Especially if it's going to say it could potentially save you, multiple six figures of taxes. It might be worth it to trip to Missouri, right? Like,
Dude, I had a guy call me last year. I won't mention people like in dentistry because, you might know them and this is all private stuff. But I had
we
a
have a
guy
lot
out
of
of
mutual
Texas call
friends.
me. It was like November. He's like, "Hey, dude," like we were chatting. He's like, "So I sold my crane company, but I'm still CEO. And like my income's like 10 million this year." I was like, "All right, crane business is good."
These are big problems that we can help you with. Yeah.
Yeah, he's like, I already bought like every piece of farm equipment I could for my ranch, right? Like bulldozers, like you name it, right?
Wow.
I still got like, I don't know, another 6, 8 million to
Hmm.
depreciate. And so it's like it's just a good solution when you're kind of like, what can I do? It works for folks. Some other things, okay, so the hours is one piece, right? The
Okay.
at risk.
Yep.
Okay. And we already
Yep.
talked about the risk though. Like when I look at the risk, I'm like, it's basically, is the equipment going to be rented out? Will they have the pool system? I know the construction business. And then it's like, can I sell the equipment at the end?
Right.
All equipment rental companies, United, all these guys, their best returns are on used equipment. Okay. So they want to buy the equipment back. Right now, it used to be 5 years, but people are like, dude, I don't want to sell you the equipment yet. So they kind of extended it to 6 years. So on average, most now is a 6 year term. At the end of 6 years, you don't have to sell them the equipment. You can kind of ask for an extra year, but usually it's just assume 6 years to keep it simple. Okay. At the 6 year point, they're typically gonna buy that equipment for about 54% of what you bought it for originally. Okay. And you've been paying down that loan the whole time. So usually when they buy it at 54 for around 54%, you get like your original money back and you pay off the loan. So you're clean at that point. Okay.
So you basically can just wipe out the rest of the loan
Yeah, you're good. So you've got the cash flow through the time, you kind of get your money back,
plus your
wipe it.
depreciation, right? Okay.
So at 54% is where they're typically buying. Okay. I told you during the recession, it was like a value's got about to
40.
40%.
Right.
Okay. So it's like, okay, well, that's like, that's 140 grand. They also do a limited loss guarantee. So the first like 99,000 or 9.9%, they're going to cover.
Hmm.
Okay. So if you get like a 10% drop, they're going to cover it. So like if it's like another 2008, 2009, like when I look at the math, like I'm like, okay, like I'm on like 40K if, hell
Worst
come
case. Yeah, yeah, yeah,
out.
yeah, yeah.
So so it's like, okay, like downside risk. I mean, that's what I'm looking at there, right? And I'm in the construction business. I get it. Like I understand it. And they've got the software. They're maintaining these equipment. It's not like you're getting something that like somebody's just let get destroyed, right? They're
Right.
maintaining this stuff. You can always check your repairs and make sure everything's getting tuned up and in good shape. Um, in that year, how's that taxed? So when you sell the equipment, it is taxed as ordinary income recapture. Okay. So in year six, I'm I have that ordinary income, that 540,000 that I would be taxed on. Okay.
Mm.
So you and I probably understand this, but I'll explain this for the audience. Every year I look at my tax problem in that year. I'm focused on that year. And I always use the
Yes.
best solutions available for that year,
Correct.
right?
Yep. Yep.
So because I know if I can keep that money and not send to the IRS, that extra 200 grand, I'm going to double it every 2, 3, 5 years, right?
Yep. Yep.
So even with paying the tax, I run the math on one of my slides. I mean, you're still like net 150 positive or more. But just in general, think about I'm solving the tax problem this year. I'm keeping that cash. I'm investing it, right? Next year, I got another tax problem. What am I going to do that year? Is it real estate? Is it this? Is there another opportunity out there, right? Or have they changed the tax code, right? I'll use
Mm-hmm.
that. And
Mm-hmm.
so as long as you're growing and growing your wealth and looking for opportunities, the 6 year piece, the tax doesn't bother me at all. When I have an investor tell
Because
me,
you're
hey, they
saying,
want
and
to,
during that time period, I've taken this money and I've made it do all kinds of gymnastics, and it's in the it's in the field making, rolling over, compounding, growing, versus me, and waiting 6 years and then paying some of the taxes back. It's worth it because I've done all kinds of stuff with the money in the meantime.
you're investing it. You're not going
Right.
out and blowing it on a
Buying a
car.
Lamborghini or a Rolls
Yeah.
Royce or something, right?
Yeah.
Yes. Yeah.
The,
Yeah.
the
Yeah.
two
No, I
things
understand.
that make sense. The two things that
Yeah.
people come to me at is like, hey, I'm retiring, right? If somebody's retiring and they're not really actively growing things, then I'm like, well, you're gonna have like an extra tax kind of issue, right? Especially if you're putting in something that's really low return that money,
Hmm.
like a 4 or 5% return. I'm like, you're gonna have a tax issue in 5 years. I don't know if I would do
Might not
that.
be worth it. Yeah.
Not really worth it. The other one is capital gain tax. It's one
Yeah.
thing to reduce ordinary income tax at those higher levels. With
Yes.
capital gain tax, I much prefer opportunity zone funds or 1031s, right?
Yes.
Each other pros and cons. But if it's income tax you're dealing with, this is the best outside of being a real estate professional and loving real estate and being passionate about real estate. This is the best, simplest, lowest risk solution I've found. And I look every year. I'm always
No,
asking
I
questions.
know you do, and I appreciate you doing that because it helps all of us. So a few questions, and I'd like to push back a little bit if I may, in a
Please.
few areas. But now, if you're a passive investor, right? Like you're literally like, listen, I run a very successful conglomerate of dental offices. I make an incredible income. I make $3 million a year. I
Yep.
want to mitigate my taxes. I love what you're talking about, but I don't know that I have the time and the know-how to do this. Now you're saying that, hey, look, but with this company, they can take a lot of the heavy lifting off of you. You're going to be buying the equipment. You're going to be getting a loan. So I'm assuming you're working with the finance, you're working with a lender, getting the loans, and they have some
Debt broker, the debt
relation.
broker,
Oh, to that broker.
based
Okay.
off of your region. I think mine ended up being like the last one was like, I can't even remember. Liberty Credit Union, Liberty Federal Credit Union, right? Out of Indiana or something like that, right?
Mm.
They have their 3 or 4 lenders that
That
like
know
a
about this
certain,
specific type of lending. They love this type of lending, and
yeah,
it's a niche sort of market. And they're yeah, sure. That makes a lot of sense. Now you get the okay. So now this part is you have a debt broker that's going to kind of connect you with the right lending piece that fits you and your situation. So I'm just walking through this now in my head here with you, okay? So now I want to mitigate these taxes. So I'm going to say, all right, well, look, I want to buy a. Now, how do we know what type of equipment we're buying? This is already sort of we have
yeah.
$1 million that we want to buy $1 million worth of equipment. What should we buy? I don't know what I should buy.
So yeah, there's typically three types of equipment. Okay. There's aerial lifts like scissor lifts, telescopic booms, articulating booms, things that lift people up, right? Then there's material handling, forklifts, telehandlers, things that lift things. And then there's earth moving, dozers, excavators, skid steers, those kinds of things. Okay. This is a sophisticated, technology driven, 4 billion a year revenue company. They know exactly what's in demand,
Mm.
right? And so they say, this is the equipment that we're buying, right? And then the management company like takes, okay, we'll take 1 million, right? I mean, 10 million, 100 million. And out of that 100 million, then they start allocating it to folks. And then they like I said, they'll
Mm,
make pools as well. So you don't choose what equipment, but when they bring the lending to you, they also bring you the equipment. They say, here's your 8 pieces of equipment, right? I think mine last time was
got it.
like 4 telehandlers, one bulldozer, and like 3 other things, right?
Mm.
And it's like John Deere. I mean, that's like, good company, good equipment, right? And so you look at the debt, you look at the equipment, and then they gave you a nice spreadsheet that walks you through your cash flows, your proposed cash flows for the 6 years. So you really know what your numbers are too. And that's when you're like, okay, I'm in. I sign, I, I wire my money over, and then like I'm in, right? And and then a month later, 6 weeks, something like that, then you start getting the checks and you get like a little statement, right? Here's you get a statement from them every month and your checks, and then the debt comes out and you're off and running.
Okay. So what can go wrong, right? Well,
Yeah.
that's what we're always looking at. Things always sound great when we're looking at all of the upsides. I know. Tell me what are the risks of this? Well, and yeah, what are the downside?
Yeah. So the market risks, right? Like down economy, right? Affects construction. Things slow down. Your equipment's not being rented as much. Equipment share likes their equipment to be rented about 75% of the time. That's about their sweet spot. Okay. The break even point on this is, I think, 44% rented. So it's not just a little dip, it's got to be a big,
Mm.
okay. So market risk, operator risk, right? Every once in a while, a publicly traded company does scam people. Enron,
Yeah.
right? Was the last one like 25
Theranos.
years ago.
Yeah, yeah,
Very rare, right? Very rare, but potentially possible. You have to be pretty sophisticated. Enron was very sophisticated
yeah.
with their schemes, right? So those, yeah, not as much. The equipment value risk we talked about, so there's rental risk with the company, and then there's equipment value risk at the end. We talked
Hmm.
about the 9.9%. So, there is some risk there. IRS audit risk. Okay. We're
I was
doing
going to ask
bonus
you about that. Yeah.
depreciation. We're doing the 100 hours, right? I mean, ideally, the IRS says always track your hours, right?
Yeah. Yeah. Don't
They always
wait
say that for
to
real
try
estate
to put it
professionals
together.
too.
You should be proactively. I do that for my real estate professional. I was advised to do that and track it. Don't try to put it together if you get audited. As long as you're compliantly and you're documenting everything that you're doing, I think that kind of, if it's well documented, my understanding is that the auditor's IRS guy is going to come take a look. Okay. And then that's it. They're not going to go any further than that if it's like, all right, these guys already done what
Uh,
it's supposed to do.
Another thing I do to mitigate my risk for audit too, is they have like certain things they just tend to audit more, right? And so they tend to audit things that go straight up to your tax return, like single member LLCs, right? So when I buy equipment, I buy it out of like, I set up just another LLC to keep it simple, right? Set up another, so I'm not commingling money with other entities.
Yep.
And then I have my wife be a partner, right? When you have partnerships, you're just less likely to be audited. So it's just, eh, I'm running everything above board, but I just like to get things clean as possible. If it doesn't take me
Yes.
much work, I just like things clean. So that's what I do. So there's audit risk. People, let's see here. They don't have any tax letters, okay, because they don't want to be a tax professional for you. One of the larger family offices, a couple of them did get tax letters. Okay. They hired an attorney group. If somebody really wanted the name of those attorney groups, I can give you the name of those attorney groups that these family offices hired to put together a tax letter. What would I guess it's going to cost if for them to write you a tax letter? 20 grand, 25 grand. I don't know that, but just from knowing attorneys
Yeah. Yeah. Yeah.
and them stating something like that,
Hmm.
I think you're going to see a number like that. Let's see, sponsor, market, deal. Um, yeah, I mean, I think. Can you think
You
of any
covered some of
other
the major ones I was going to ask
fears?
you about. Exactly that. The sponsors,
Yeah.
the dealer, the market, especially, things bottom out. to, construction obviously bottoms out too, but as you said, and then hey, look, things really slow down. Then how does the government start trying to speed things up? Well, number one, they start cutting interest rates. Number two, they start creating jobs, right? Hey, building airports and roads and highways. Yes. So that makes a lot of sense. And I guess that construction equipment will come back. I guess it goes down quickly. Construction leasing activity in really bad times will drop off quickly, but it ramps up quickly too, from the sounds of it.
And and if you're really struggling, are you gonna go buy equipment or are you gonna go rent it?
Rent it. Yeah. Right. Yep.
And
Makes
so it
sense.
also is a
You're
little
not doing
protected
capital
that way.
intensive things when you're in difficult times, right? So,
Uh-huh.
yeah, no, that makes a lot of sense.
Yep.
Um, yeah, I mean, this sounds really powerful, and I think that it can be something that could really help a lot of the people that watch this show. So, Josh, I got to jump off here in a second, but well, first I want to thank you again for spending the time. Right now we're recording on a Friday afternoon. Actually, it's kind of Friday early afternoon for you on the West Coast. It's getting to be almost 4 p.m. at Friday for me. So a little bit different. I think your day's sort of midday. I'm like already getting towards the end of doing office work. But before we sign off, Josh, so first, thank you again for spending the time. Always great to see you. Yeah, always great to see your smiling face. Wishing you all the best to continue moving forward. But before you sign off, how can the listeners get learn more about you and reach out to you?
Yeah, yeah. If you just have questions about anything, always happy to help. I was in the dental chair. I built a 160 team member dental group. It was hard. It was really hard, right? And it doesn't stop being hard. So if you guys ever have questions about dental, always happy to help about getting free, finding that freedom, time for your family, health, anything like that. Those are things I'm passionate about, like Johnny. If you have questions about equipment, like reach out to Johnny and Johnny can get you more information
Yeah.
about
Yep.
equipment, all the legal stuff, all that kind of stuff. Happy to send those things out for folks. Um, yeah, I'm around. This afternoon though, I got to go meet with a potential property manager that used to work for Graystar.
Nice.
She got 10 years of good experience. I really like her. And then I got a closing. We're looking at doing like a 150 unit downtown near Gonzaga
Is
University.
that I saw you were doing one near some sort of some like urban, like some rural land, like it's adjacent to like some I don't know if it's a park or
That one we started in December actually. Yeah, that one was five. It's like in town. It was a 530 acre like nature preserve, like
yeah,
in
easy.
town, right?
Wow. It's a
And there's no
backyard.
other like apartments on it. And I found this little piece of land, and it's like we're gonna put a trailhead like right there. Like if you have a dog, you like to walk your dog, you like to hike, mountain bike.
It's right.
Um,
That's your
I'm
backyard.
like, dude, it's like 4 minutes from the
Amazing.
freeway. I'm like, dude,
Amazing.
this is sweet for any outdoor enthusiast. So yeah, we're 4 months. I mean, we had to blow up the side of the mountain though, because it was like on a hill. So we had to like,
Wow.
it's good
That's
now though. It's
amazing.
pretty flat now. That's a fun one. Yeah, this will be more like urban stuff. It's crazy. It's all the stormwater drainage, right? Because like when you're building like downtown stuff, it's all about like some of the big challenges are like where do you put your water, right? Because the city doesn't want it. Anyways, so there's different challenges, different
Yeah,
locations.
yeah. Josh, always a pleasure, my friend. Thank you again, man, for being here. And yeah, look forward to seeing you again soon. Any parting words, thoughts?
Yeah, don't settle in life, right? If there's something that's bothering you as a dentist or business owner or professional, like really think about what you really want in life. Friends, family, faith, whatever that is, fitness, like really just identify that and don't be afraid to make it your reality. You can do it. So
I love it.
good.
I love it. I love it. Great parting words. All right. Thank you, my friend. We will catch you next time. Thanks, everyone. And we will catch you on the next episode.